All right, joining us now, Julia Coronado, founder of MacroPolicy Perspectives, and our guest host for the hour, Savita Subramanian, Bank of America, Merrill Lynch. Just overall, Savita, we'll start. Welcome as our guest host, but you're torn. You're neutral.
Torn, yeah.
You're torn between dovish central banks.
Yeah.
Versus recession concerns in the trade war, but this is what we talk about all the time.
Absolutely.
So that just makes you like sort of just not sure which way to go.
Well, look, I think the market is a buy because of the yield that it offers. And I think the thesis right now is we're likely to stay in this low interest rate environment for longer. And if you look at the S&P 500, 60% or more of the stocks offer a dividend yield that's greater than the 10-year. This is like a weird, wild world that we're living in, and we've been in it for the last 10 years, and the markets continue to grind higher. So our advice to investors in these uncertain times is look for stocks with a sustainable dividend yield where you can meet your income requirements and you're protected on the downside. But, in terms of the S&P 500 from a price perspective, it's hard to say. I mean, don't fight the Fed. We've got a very accommodative central bank policy. We've got accommodative central banks all over the world. But we've also got trade friction. We've got companies in paralysis mode. CapEx spending has declined. So I think there's a lot of puts and takes here, which kind of forces us into these yieldier areas of the market.
Julia.
Yes.
Yield curves.
We're inverted. What are they telling us?
Well, they're inverted again. We've also for about a month now, we've been explaining this time it's different so many different ways. It always makes me uncomfortable. It's always an uncomfortable thing to say. So
it is uncomfortable.
The latest is in the journal B1, bonds big swings amped up by a market strategy, and it's just simply saying that all these people, all these institutions that need yields, they're on autopilot. And they scoop up bonds because that's what their pre-existing risk models and investment hedging strateges tell them to do. And I mean, they do have money.
Price insensitive is the suggestion.
Right. So,
it's not a signal.
Does it mean? Is that true? Does this not? Is there a recession being forecast by the bond market?
Well, it certainly is a warning signal. I don't think there's any way you could look at it any other way. If the fact that people are comfortable with those kinds of investment strategies tells you something about the riskiness of the economic environment. And we can look at the economic data, and the global economic data, the UK PMI, all of the PMIs are looking pretty recessionary. We've got a lot of political uncertainty from Brexit to China to the U.S. That's only going to intensify as we move closer to the 2020 election here. That just reinforces the paralysis that you cited in terms of the CapEx willingness to invest and hire.
Small businesses are supposedly being...
Everybody,
they're getting,
from small to large businesses.
You can see it now, the trade war.
Yeah, so of course the large global supply chain businesses can see it most clearly. But yes, even smaller businesses now can see that what are the prospects for growth? Where am I going to get my growth? It's harder and harder to see.
So
I think the one area of strength remains the consumer. I mean, that's the bright spot. And we've had many recessions over the last 10 years. We've had an industrials recession. It wasn't really that many. It was actually pretty big.
In 2015.
In 2015.
Yes.
But the consumer and tech held up strong enough to carry us through. I mean, do you see that type of scenario playing out where we could potentially see a manufacturing recession, but the consumer keeps us going?
So without a doubt, that is a dynamic we're going to see, that we're going to see a manufacturing recession. We're already there globally. The U.S. is moving in that direction. The U.S. consumer has been much more cautious this time, which is a good thing. They're more stable. They haven't over-borrowed, over-leveraged. There's not a lot of pullback needed. So that is the hope of avoiding a recession. If we're going to do it, it's on the back of a stable consumer, a domestic service sector-oriented stability that offsets some of these global headwinds. It still is a possibility. I think it's a clear possibility. I'm not forecasting a recession yet. I think the probabilities are about 40%.
No one ever forecasts.
No one ever forecasts.
They don't, but they go up in there. No, I was going to say that they go from 30 to 40.
Well, yeah, and that's what the yield curve is telling us too, right?
To go from 30 to 40, that just seems like useless information. I mean, I don't know how to feel about.
And yet our clients ask us for these probabilities.
Right.
So
I mean, okay.
Question about the CapEx.
It's still 60% that you don't get one.
Yeah, and that would be the story of the U.S.
So instead of 70%, it's 60%.
And I think you mentioned also the accommodative central banks. It's not like they're frozen. They're doing something to offset it.
They're doing everything they can
and
to
that
offset.
has an impact on market sentiment, and that's an important piece of the puzzle.
When you guys talk about the slowdown in CapEx, though, do you think that's a function of China, or do you think that's going to be a function of the election? And how are they interrelated?
Or both, yeah, both. I mean,
I think it's more China, actually.
I think it's more China?
Yeah, because I think that we're in an environment where the global supply chain has been massively disrupted. You've got companies, moving sourcing to other regions of the world. You've got paralysis mode in terms of where do I set up my new plant? And, every day there's a different number bandied around about tariffs. I think it's an environment where it's really hard to plan anything for the future.
And to that, I would add, even before the trade war intensified, we were seeing a global manufacturing slowdown. China's been the engine of global manufacturing. They are seeing growth slow on a structural basis. And that's a reality that companies are going to have to grapple with and reorient their business models towards.